Arora, CEO of Nirmal Bang Institutional Equities, joining us now. Very good morning to you, Rahul. We had a comment this morning from one of our speakers that said this is worse than the worst case scenario. Is it really?
Morning, Tamanna. Thank you for having me on the show. I think it's a little too early to comment on exactly how this is going to play out because this has happened practically in the dead of the night. So I think even the government of India is going to take some time to understand its complete impact. Lesser mortals like us will probably take a little longer time. But yeah, I think to the extent that 26% reciprocal tariffs have been announced, I think the one thing that is clear, Tamanna, is we're very obsessed with the equity markets. Every now and then it's probably, it doesn't hurt our cause to just veer into the bond market and see what they're doing. And I think if you looked at the 10-year in India yesterday, and the fact that the US 10-year fell by about 3.5% yesterday, somewhere it is indicating that we're going to head into a massive slowdown / minor recession at some point this year. So I think the bond markets traditionally tend to move ahead of equity markets, and they're probably more accurate in terms of forecasting. So obviously, this is going to have an impact. It's a little too difficult to quantify what the extent of the impact will be. But as I was hearing your colleague, there might be some, benefits to India vis-a-vis countries like Vietnam, etc. But I think the differential with China has by and large been taken out of the window. There's just a 7-8% differential with China on the reciprocal tariff. So we'll have to see. There is no question this is going to be inflationary. There is no question that this is going to have an impact on US consumption, and that the C part of their economy will slow down. And add to that we're not closer to resolving the war situation in Russia and Ukraine. And President Trump is finding ways to be elected for a third time. So I think we're starting the fiscal year on many uncertain notes. It's a little difficult to quantify exactly, how bad this could potentially be. The only one area of ambiguity, Tamanna, if I may, is on the pharmaceutical side of the tariffs. I think I've read a lot of reports since the morning saying that, pharmaceuticals are exempt. I think a slightly deeper read of that may be warranted because India does, of its $46 billion trade deficit with the United States, almost 15% of that is pharma. So if you were saying that reciprocal tariffs were imposed but pharma was exempted, that's a huge thing. So I'm not sure if that's entirely true. It would require a slightly deeper read, but I think that's probably one headline that people have latched onto, but I'm not sure if that's entirely.
No, but Rahul, so there is a White House statement which says that things like copper and pharmaceuticals are exempt. So why a deeper read?
I think, Neeraj, if you look at what the president's speech itself said, he said he wants to bring back pharma manufacturing to the US. I think that was the one line that he himself said. So I'd want to read the fine print. I'll be very honest with you saying that I haven't because it ended at 2:30 a.m. our time. So it probably requires a deeper read. But
understandable.
I just think, Neeraj, this is going to be ongoing, right? I think you've seen this with Mexico. He imposed tariffs, then there were some issues with migrants that were addressed. And I think on a case-to-case basis. But one thing is clear, Neeraj, I think, if you and I were having this conversation, say in October last year, in an era of globalization, nobody thought we'd be going into a world that was inward-looking and protectionist. So I think that's the new reality for the next at least 4 years. And if he manages to secure a third term, then maybe another 8 years. You never know. So it's not going to be easy on global growth. That's a certainty. But like I was telling Tamanna, it's a little hard to quantify. The one thing I'll say, Neeraj, and I'll say this at the absolute outset of the fiscal year, I don't think this is a year we're going back to the new highs, to the old highs. I think 27,000 on the Nifty is a distant dream now for the remaining 9 months. That's one thing I can say with some reasonable assurances, I think.
Fair call. Rahul, we are about a minute and a half left from market open. So very quickly, are there, in a minute if you can answer, and then we'll do in detail, are there net beneficiaries from this? You look at pharma deeply, fine. Anything else?
Not as such, Neeraj. Nothing that will move the aggregate, earnings per se. Because from a market perspective, it's IT, FMCG, banks, and Reliance. That's basically 75% of the Nifty. I don't think it's going to, move the Nifty in a major way. I don't think there are going to be too many material benefits that are coming out of this, is my sense.
I'm going to talk about this in more detail, Rahul, with you, of course. Srikanth, very quick view. We've got a minute left. Anything that stands out that you've seen in pre-open that gives you the confidence to place a bet?
I think, while looking at the bond yield and all, I'm of the view that we should look for taking some contra view on banks, large bank especially. And in that, we like ICICI Bank, which is around some 13 1330, 1335 sort of levels. In case if there is any lower opening, then it will be an opportunity. Around 1300 levels, the stock is having excellent support. This stock can again move back to the levels of 1400. So Axis Bank, HDFC Bank, as well as ICICI Bank should be on the watch list.
Okay, okay, okay. Shrikant, not taking any contra trades, right? Are you? 20 seconds left, aside of banks. Any pharma, anything else? 20 seconds?
Yeah, from the pharma space, specifically, we like Syngene. It's a contra play, but I would say that this stock can do really well. It is consolidating around 720-25 levels. And if we consider its technical pattern, then I think the stock can again move back to the levels of maybe 850, 860. So there is a decent upside.
Right. Okay. Okay, okay. Shrikant, we'll have to start the markets. So, big drop on open. Is it as bad as people thought it to be? 160 on the Nifty. This is actually well behaved, I must say. This could have happened on any day that it's happening on the day after the tariffs have been announced. Pretty good reaction, I would say. This is music to the ears. The Sensex was 800 points on pre-open. It's 513. Now, this could change, of course, but the open is very interesting. Yes, IT is feeling the indirect impact. US growth slowdown is being seen out here, which is why another 2.5% for Nifty IT, which has already fallen about 20%, by the way. Bring up mid caps and small caps. I wonder if they are also well behaved. This is extremely strong positive reaction. Anybody would have told that the small cap index will be down only 0.2%, and you would have thought that, you know, the person needs to rewire. But okay, now sinking a bit further, fair enough. We'll wait for the first 5 minutes to actually pronounce how good or bad start it is. But let's get individual stocks and just see what's happening on the large caps at least. A tick of red, a large tick of red. IT is suffering. HCL Tech, Wipro, TCS. If you thought IT had not gotten tariffs, yes, they haven't, but the slowdown impact out there. Bajaj Auto, 2% interestingly. Adani Ports, ONGC, Zomato. So no necessary reaction only to tariffs. Other things are happening as well. And on the flip side, pharmaceuticals, Dr. Reddy's, Sun Pharma, Cipla. Well, that's the bucket of strength out here. Very interesting start, Tamanna.
It's exciting to hear you say, Neeraj, 150 points down is music to the ears. At least not as discordant a note as one would have expected, perhaps. But yes, it's a tough morning, no doubt. I want to just pull up the advanced decline ratio if we can, and then re-look at the sectoral indices to get a sense of the broader markets. And this is what should give you some heart. It's not so skewed. 836. Advances to 1409 declines. So this algorithm is not half bad, and this is how, you know, we're looking at where the market is going this morning. Let's pull up the sectoral indices just for a second for you, and no prizes for guessing that the Nifty Pharma will be right on top, but 4.5% up. Healthcare, CPSE is okay. A sea of red. Nifty IT is expected to be a bit shaky. Bajaj Auto and the others have had their updates out. Perhaps that's not something that the street is liking. Plus tariff impact. So you're seeing the tariff impact on one end, but also a market which is seeing some strength coming in at these levels. I want to pull up the top gainers and losers on the broader indices before we get to specific stocks, because that will give you an overall picture much more clearly. And you know, we spoke about Gland Pharma this morning when we spoke about pharma stocks. That's about 9.5% up. Dr. Reddy's, Lupin, Oro Pharma. You can see it's all about pharma stocks right now. Sun Pharma, Zydus, Suvain. On the losing side, Dabur India, because of poor business updates, and that's where the pain is. And then it's a whole bunch of mid-cap IT stocks as well. Persistent, KPI Tech, Emphasis, Coforge, and the like. Sona, BLW, obviously the tariff impact over there. So this is going to be the broad theme that we'll see through the day. And Alex, that's what's going to dominate at least for the first half.
Absolutely, no doubt. Then you've highlighted several names that are reacting from the healthcare and pharmaceutical space in particular. On the downside, we'll speak about Dabur in more detail, but I just want to pull up the small cap index as we're speaking, because Neeraj and I were having a chuckle about this. Look at the small cap index. It is turned into the green. It is trading with gains of 0.25% at this juncture. And at the way that things have opened up, you wouldn't be too surprised if even the texture or the breadth of the market changes over the course of the session for it to favor the advances. At this juncture, of course, declines are favored. But I want to go back to Rahul on a point that he was making with regard to the China differential and that going out of the window. I'm just wondering, Rahul, whether this tariff that has been announced overnight, there's no clarity as to whether this will pile on to the tariffs that were announced earlier. And so if that is indeed the case, then that differential does not go out of the window, right?
Yeah, so I think what is assumed is that it's an extra 16% on what was already announced previously. And I think the total tariff right now rests at 26%. That is our understanding. Again, as I was telling Neeraj a little earlier, this is open to interpretation because it's still early hours. We'd like to hear from the government of India officially as to how they're reading it. But I think if you were to just look at the absolute number of 26 versus 34 on an 8%, I don't see too many companies wanting to move manufacturing or anything like that away from China just on this tariff differential. If it's incremental over and above what you're saying, then that certainly holds. But if it's an extra, because from what I have understood is he's just ascribed a 50% on the value added tax, which is basically the tariff plus the non-tariff plus VAT, and he's just assigned a 50% on that. So I think it's more incremental, and which is why I think that differential at 8%, is not something to write home in a very material fashion. But as your colleague was mentioning a little earlier, I think the differential with companies like Vietnam, Bangladesh, etc., is very large. Now, whether that results in textiles or electronic goods or chemicals moving in from these countries over to India, or even coffee for that matter, because Vietnam is a very large coffee producer, that remains to be seen. But again, like I was saying, I think, the overall trade deficit with India is about $46 billion. So it's not going to move the needle in a very material way from an absolute tariff point of view. I think the bigger indication is on global trade, global growth, and therefore the resultant impact that we're seeing on India. And I think that's why I started my discussion with looking at the 10-year bond yield in the US and in India, where what this implies for residual growth as a result of these measures.
Yeah, and very pertinent points that you're making. Rahul, from that perspective, just to take that conversation a little further, we're talking at a time when Dabur has come out with commentary, and the consumption story that we're talking about from that perspective is not as strong as one would hope, especially in the context of a global growth slowdown, particularly in the US. So obviously, the attention of the Indian investor turns inward, and that's not looking like a very pretty picture yet either. So where do you deploy funds at this juncture? How do you behave?
So I think you've hit on a very important subject, Alex, and I think maybe I'm sounding like a bit of a contrarian right now. And believe you me, the heart is bullish, and we want India to do well because my business relies on the markets going up. But I don't think people are factoring in earnings downgrades to the extent that they are supposed to be. And I think if there's one thing that the last 4 quarters have taught us, it's on average 60% of the stocks are getting downgraded across the universe. Now, let's take all the 3-4 pieces of the puzzle which can potentially move the index. And this is what I was saying to Neeraj a little earlier. You highlighted Dabur. I don't think FY26 is going to see even a 10% profit growth for consumer companies on the large cap consumer staples. IT, I think the three of you have been discussing. Again, if you look at the large cap companies, TCS, Infi, Wipro, HCL, Tech Mahindra, again, you're looking at about a 10% kind of earnings growth if you're lucky out there. Now, banks, the credit growth has already, if you look at the scheduled credit growth numbers that have come in just a couple of days back, in the non-food credit, you've already dropped down to 11%. Retail, agriculture, consumer loans are all down to about 11.5%. Industry credit growth is down to 7 to 8%. So if you're going to go into a situation by FY26, you have banks, IT, and FMCG broadly going to give you 8 to 11, 12% kind of earnings growth. Even Reliance add to that probably a 10, 12% earnings growth. You tell me how the index is going to move if you value companies on FY20. It is not possible. Now, that is why you are seeing that the entire sell side and buy side has moved to FY27 at the start of FY26, because you're not going to be able to, justify companies on FY26 valuations. Now, look at the auto sales numbers that have come in. PVs are struggling. Yes, luxury two-wheelers like Eicher and Bajaj Auto and the likes have done well. Exports have done well, but domestic is struggling. So what are you left with, right? And I think if you look at the last 2 years, the road awardments that the NHAI has done has been very poor. In fact, the NHAI has not met its own target. So cement growth comes into question, whether you are actually going to get 7-8% kind of growth in cement. So you are actually looking at a year where I have systematically broken down for you sector-wise as to why earnings growth would be a challenge. Now, the only question is how far does the market want to look out, FY 27, 28, and then start justifying valuations? According to me, since you bought up the small cap index yourself, Alex, a few minutes back, I think most small caps in India are still at least 20 to 25% overvalued on a 3 and a 5-year mean. Most of them are still trading at 1.5 to 2 standard deviation above mean, or at least 1 standard deviation above mean. Now, does that mean the market will correct? I don't know. But is there a case for the Nifty to visit 21,000? I think there is a very strong case.
21,000. Wow, Rahul. You are... Okay. We need to have a...
I'm sorry to speak my mind, Neeraj.
No, why should you be sorry? No, Rahul.
It may be an anti-consensus view, but I'm arguing with logic here. I mean, I'm happy to listen to a counterpoint of view.
Rahul, we get you for you speaking your mind because it helps. So thank you for putting that out. Please don't be sorry at all. No, but this is important. Sorry, either of you, I have a question to Srikanth, but either of you want to make a point?
No, absolutely.
I was just making the point that, Rahul, so what do you do right now? You're rightly saying IT is looking bad. We have underestimated how painful your quarterly numbers are going to be. So what is the strategy right now for an investor, for a viewer who's watching? What's the outcome of everything that you're saying?
So I think, Tamanna, it's not all gloom and doom. Yeah. Let's look at where earnings growth can come, right? There are 2 sectors that straight away tell you earnings growth, or actually 3 that tell you earnings growth can come. One is consumer discretionary. I think hotels are still doing well. Airlines are still doing well. Alcobev stocks are still doing well. I think those are 3 pockets where we could still buy because I think earnings growth is still going to be strong. I think the one sector that has gone into a different orbit in India, and I think that's large part thanks to the Prime Minister and the Defense Minister, is the defense sector. I think if you've looked at the news flow over the last 30 to 45 days, we've had close to about 1 to 1.5 lakh crores of orders that have been announced and awarded. And I think you've seen the defense stocks rally. So that could be potentially another area. And the third is agrochemical stocks. I think that could also have a very good play. I think valuations have reset. I think if you look at names like Sumitomo Chemicals, which we're recommending, I think you could look at 25-30% kind of growth in some of these names like Sumitomo. I think in defense, we have recently upgraded Solar Industries. We like Hindustan Aeronautics. We like Bharat Electronics. You know, I recently met the managing director of a very large, defense equipment manufacturer. And he said the amount of work that they have done in Russia, Ukraine, and Middle East, that when these cities come up for reconstruction, that's a huge opportunity for some of the Indian companies that have done work there. So I think off the bat, defense, consumer discretionary, look like 3 sectors where we could potentially look at. And in auto as well, I think luxury auto, whether it's an Eicher or companies that are strong, exports, also very large spare part components like a Bajaj Auto. I think those could also potentially be looked at. So it's not like you can't be buying stocks. And I also think mid-cap IT, while the growth rates will come off, I still think there'll be at least 2.5, 3x than what the large cap IT companies would give you. So you could potentially look at names like Coforge if that interests.
Wow. Okay, Rahul, that's a nice list and nice summation of almost everything. So thank you so much. And once again, love you for speaking your mind. So please continue doing that.
Thank you so much for having me, Neeraj. Appreciate it.
All right.